Hello students, I hope you are doing well. Now JK Shah classes welcomes you for one more segment that we are discussing now. It's about RTP of November 22 attempt. Yes, your attempt. And myself, Professor Mayuresh, I will discuss the entire RTP, and meanwhile I'll also discuss those concepts briefly so that it will be some sort of revision for you guys. So let's get started with the first question. Question number 1. Nutty Bites produces many edible snacks that are very popular, especially among children. Peanuts oil are essential ingredients in many of these products. They are currently facing this ethical issue. So guys, this is giving me some hint about ethical issue being faced by the organization. Medical studies have indicated peanuts allergic reaction are on the rise. The prevalence is more profound among children. Reactions can range from hives around the mouth to potentially life-threatening reactions when exposed even to the slightest trace of peanuts. There is a growing media campaign to force companies like Nutty Bites to make disclosure about the presence of peanut on its package labeling. So you as a company, you are expected to disclose if your product has an ingredient mentioned in the question, that is peanuts or anything related to peanuts oil or something. Nutty Bites is a mid-sized company that has a growing market. Risk to peanut exposure can come not just from the presence of peanuts in its product. Some of its brought-in ingredients like raw material input are cooked in peanut oil. So guys, you may not be using peanuts or peanuts oil on your own, but the raw material that you are using, the raw material that you are buying from the supplier, that raw material may have some trace of peanuts. There are risk of cross-contamination among the products. Cross-contamination means I'll give you a simple example. There is a utensil. You mix something in that by using peanuts oil. Now you just remove it and use that same utensil for making some other product. Just imagine. So you have not wiped it off, you have not cleaned it. So it's that utensil still has some traces of peanuts or peanuts oil. This is cross-contamination. What they have to say about it? Let us say an equipment has been used to produce cookies that has peanuts, and next the equipment is used without being cleaned to produce chips that does not have peanuts as an ingredient. Some portion of peanuts or peanuts oil may contaminate the specific batch of chips produced. Since labels of chips would not mention peanuts as ingredients, it poses a potential risk of causing allergic reaction to customer unaware of this contamination. Management of Nutty Bites has called for a meeting to discuss this issue. The issue need not be addressed at all. After all, Nutty Bite is doing nothing against the law, is the option of many members of the board of the company. What are we supposed to do as a student? Explain why Nutty Bites should attempt to address this issue. State potential benefits that business can garner by addressing this issue. Recommend with reasons avenues available to Nutty Bites to address ethical issue and evaluate the recommended solutions. Now, the first question is, why are we supposed to address this issue? Guys, it's your moral duty to do that. It's your moral duty to inform the society. It is your moral duty to inform the universe or the customer base about such issue. The reason is, you are not doing anything wrong. You are not doing anything against the law. But still, from your side, there is a contamination. If there is a contamination from your side, it is going to cause health issues to many people outside. So it is your moral duty and it is your social responsibility to mention, to go for a disclosure. My second question is state potential benefits. Potential benefits, you will avoid bad publicity. The defamation will not be taking place. Otherwise, people will defame you. See, when you have written that it contains peanuts oil, people, those who are allergic, are supposed to stay away from it. You are free from your responsibility. So guys, point number one, there won't be a defamation against you. There won't be a bad publicity about you. Secondly, you may avoid legal actions which are probably possible if things are going wrong with people. And the most important part is, since you are avoiding all these things, you are taking care of the workforce as well. You may be having employees, you may be having workers also who are working within the factory, who are working inside factory and allergic to peanuts. So you are not only taking care of the outsiders, you are also taking care of your own staff when you do this, when you go for disclosure. So this is what we were supposed to write. One is the moral duty, and then the second word term I would like to use is social responsibility. Reasons: bad publicity, legal actions can be avoided, and well-being of employees will also be taken care of. So these were your first two answers. What is the third one? Recommend with reasons avenues available to Nutty Bites to address this ethical issue. What are the avenues available, guys? What should we do? A clear warning on the box. When you have a clear warning on the box, no one can file a suit against you, because you have already given the disclaimer. Since you have already given the disclaimer, now it is a responsibility of the customer to read it, and you will be excused. Then you'll have to segregate areas to have separate processing lines of products with peanuts line and those without it. I will have to separate two product lines. Wherever I'm using peanuts oil, of course I'm keeping that separate, but even if there is a smallest particle of peanuts or your peanuts oil is getting used, the better way is to keep two lineups separate. One with zero peanut and peanuts used related products. And like we have so many restaurants in India where veg kitchen and non-veg kitchens are different. The staff is different. Jain kitchen is different. There is a separate Jain counter, or there is a separate Jain preparation which is done by separate staff. That safeguards the possibility of contamination. Equipment should be thoroughly cleaned while switching the production from one variety to another. But guys, if I'm going for the first one, if I'm going for the second one, if I'm having two different product lines, this problem will also be solved. If you cannot go for two different product lines, it is better to have, it is better to clean the machine or clean the vessel or utensil, whatever you are using for the other product line. Storage of peanut material should also be separately managed. There should not be a trace. You can always keep the stock also separately so that they don't get mixed up. If Nutty Bites has resources, it could invest in pharma companies which are finding out solution of these allergies. Because if there is a medicine on this disease or there is a medicine on this allergy, it is ultimately going to help you as a company, because if people are not allergic to peanuts, more and more people currently who are allergic to your product can also buy your product, because if there will no longer allergy problem faced by them. So that was your point number 3. What is your point number 4? Evaluate the recommended solutions. Now, I would like to evaluate a recommended solution in two different manners. One is risk. I'm talking about product safety. Okay. If I'm thinking from long-term perspective, product safety is the only important factor I need to focus on. I will see to it right from the stage of procurement till the stage of distribution. Right from the stage of procurement till the stage of distribution, I will see to it that there is no contamination. That can be done by having two different production lineup. There can be two different procurement lines up. There can be two different distribution lines. It is possible. So that is one thing. And secondly, this contamination is a need to be taken care of. Now, practically, even you know, it is not 100% possible. It is not 100% sure that we will be able to avoid the contamination. But then you can always have inspection. You can always have quality check. You can always have such sources or such resources used in order to either avoid the contamination or in order to find out the contamination, so that such products should not be distributed. So basically, to conclude, we are morally responsible, which may avoid maximum problems faced by us, and we should streamline the storage and production process to avoid risk of cross contamination. This is what we were supposed to answer. So that was about your first question. Let's go to the second. Nations Mart is a supplier of packed grocery items to local kirana shops and department stores under a franchise model. Such local kirana shops and departmental stores are not an exclusive franchisee of Nations Mart, because certain other items such as wages, cosmetics, eggs and bread, etc., which are not offered by Nations Mart, these local kirana shops and departmental stores are free to buy from the other suppliers. Nations Mart offers items under its own brand, and they purchase the grocery items either directly from manufacturers or from their established suppliers at a significant discount, part of which it passes to such franchisees, local kirana shops and departmental stores. It is estimated that such local kirana shops and departmental stores save around 8 to 12% of purchase prices on items supplied by NationSmart. For inbound logistics, since its establishment, NationSmart relies upon the manufacturer or their established suppliers, and in some areas and in some cases use the service of haulage contractors working on behalf of these manufacturers or suppliers. Haulage contractors. Haulage contractor means commercial transporters who are used to transfer or transport goods from one place to another. NationSmart purchases items into their large and multi-purpose regional warehouses. So storage is not a problem. Warehouses have facilities for repackage of items in smaller units. Each regional warehouse has designated geographical areas to serve. NationSmart sales representatives conduct the meeting with each franchisee, into brackets, local kirana shops and departmental stores, after every 8 weeks to decide the weekly standings order quantity for the upcoming 8 weeks. So basically 8 weeks is a planning cycle for you. Such weekly standings order delivered to these local kirana shops and departmental stores through specialist haulage contractors local to regional warehouse. Such local kirana shops and departmental stores can increase the weekly order through phone or email, but cannot reduce their standing order requirements until the next meeting with the sales representatives of NationSmart. The board of directors recognize the need to review the supply chain to enhance the brand recognition of NationSmart, also address the issue raised by franchisees. See, the first thing, this is the first thing to be done. The board of directors are supposed to review the supply chain. Secondly, address the issue raised by franchisee regarding inflexible operating and delivery system. And then we are also supposed to advise the board how NationSmart can restructure its supply chain, presuming it keep on supplying the repackaged items. So 3 things are to be found out. So guys, if we need to understand or if we need to answer these 3 questions, we need to understand first of all what is supply chain. See, basically, when I talk about supply chain, let me tell you, it includes everything. It includes everything, right from procurement till your customer. Supply chain includes everything, right from your procurement of material to the customer. Like for example, it includes suppliers giving material to me. It includes manufacturers. It includes wholesalers. It includes retailers. It will include warehouse keepers. It will also include the end consumer. So basically, it is a holistic approach that is required to be taken into consideration. So basically, when we talk about supply chain, we have a few approaches to be dealt in. First one is inbound logistics. Inbound logistics will take care of how the suppliers are managed, how the material is ordered, how it is transported, Everything related to the procurement of material will be taken care of here. When you go for inbound analysis, you are supposed to take care of activities related from procurement, like from even from placing the order, how things are analyzed, how orders are placed, how the suppliers are selected, whether the inspection process is going on at suppliers premises, because I need to maintain the quality. In order to safeguard quality, I may undergo a policy that my team is at supplier's warehouse, is at supplier's outlet, verifying the material at the time of loading it. So I'll get material, I'll find out the flaw, I will return material. It will not only cost me a few rupees, but it will always waste my time. So that can be inbound, everything related to your material procurement. Then comes operational activities. Operational activities are actually concerned with how the products are converted into finished goods, how they are actually produced, how they are distributed. Now, distribution part will be covered under outbound logistics. And then we also have one more logistics like marketing and sales. So basically, see guys, what I'm trying to tell you is you evaluate every single aspect related to the entire organization. We in this question are concerned with the supply chain in terms of purchase of material. So we have two options here, two strategies to be evaluated. One is upstream supply chain and the other one is downstream supply chain. Upstream is related to the supplier, downstream is related to the customer. Upstream is related to supplier, downstream is related to the customer. So how do we deal with it? First, we'll go for inbound logistics, develop in-house logistic capabilities. Then see, you can have your own trucks and tempos. That means you must have your own vehicles. So I need not be dependent on outside transporter. Use third-party logistics rather than manufacturers. And they're established suppliers, and that too in conjunction with the review of outbound logistics. If you're using third-party logistics like outsider, you will have to find a golden mean between services rendered by outsider and services managed by the organization. Like sometimes, if my cost involvement is huge or if my period involvement is huge, it is better to outsource the distribution part, or it is better to outsource the delivery part. See, cost benefit analysis is to be conducted. I told you, no. If it is better, there is a large quantity of material is being which is required to be transported. I won't mind having my own fleet of vehicles, and I can spend on those vehicles. I can maintain a separate department like what L&T, like what Bayer is doing. They have their own fleet of buses for rendering services to their employees from a particular railway station to the company. They have their own buses. So that saves the transportation headache of the commutation headache of the employee. So employees are also happy. By you go to a particular station, come out of the station, you will get a bus, sit in the bus, you will be taken to the destination. You need not wait for your local public transport, you need not spend on auto rickshaw, you need not go for cab or taxis or something. You have a transport facility, commutation facility. Now since large number of people are enjoying the services, are getting benefit out of it, company has its own fleet of buses. There is a separate division which is looking after this transport facility. But if there is a lesser number of transactions, it is always better to go for outsourcing. This is what we have done in make or buy concept also in decision making. So this is one more important thing. If you really want to maintain the material, if you really want to have a control on the material, don't go for push approach, go for pull approach. Push approach is you produce, you distribute, you dump it in the market, let the customer buy it. I don't know who the customer is. I don't know whether there is a demand or not. If customer is buying my product, there is a sale. If the customer is not buying the product, there is no sale. First of all, you'll have to produce it unnecessarily even if it is not getting stored. So basically there is a huge storage cost required to be incurred. Plus your funds are blocked because you are spending money on it. So there is an opportunity cost. Plus since you are dumping products in the market which may or may not be sold, there is a risk of your products being obsolete. Please don't go for all these things. Go for pull approach. Let the demand come from the customer. Then I will start producing the product. Once I start producing the product, I will see to it the material is delivered on time. So just in time system can be implemented. So I will buy material only if there is a demand. So I'm not supposed to store the material. My carrying cost is tremendously reduced with all this. Plus my funds are not blocked. Neither in terms of buying the material nor in terms of producing the finished goods. I am producing made to order. I know who the end customer is. I know there is a demand. I know my product that I am producing right now will be sold. I don't mind spending on material and finished goods. There is no opportunity cost, guys. Because I'm not going to store anything to a larger extent. So I'm not going to buy anything in a huge quantity. So that will also be taken care of. Now, flexibility while ordering is the benefit that I'm discussing right now. If there is a need, like take example of Maruti Suzuki, but now Ertiga is made to order, 8 months waiting, 9 months waiting, Maruti Ertiga, right? So they get an order, then they start producing it. So if they are getting order for ZXi, they need spare parts of ZXi, they will not go for LXi. So guys, there is enough flexibility while ordering because now you know exactly what you want. Earlier, it was a push approach. I was producing LXi, I was producing ZXi, I was producing VXi. So all different types of materials were purchased, all different types of materials were stored. I was not focused on one particular part. Now I'm being focused on one. I know what I need. I will place an order only for that. I will store only that till it gets consumed. Why would I order the other material which is not required? You can take help of IT solutions like placement of orders and all. You get an order or consolidate your orders from local shops by using IT, information technology, not income tax. Okay, so there can be EPOS. EPOS is electronic point of sales, whereby your local kirana shops and departmental stores can have an overview of sales information, stock level and customer habits and trend. So even local shops will come to know what is basically required to produce the product, what is basically required by the customer. So accordingly the demand will be managed, demand will be analyzed, demand will be found out, and accordingly the order will be placed. Like for example, if I need particular type of product is in high demand, I will try to fulfill the demand of that product only. So accordingly only that material will be ordered for. So customer evaluation is also one of the things. Then we have outbound logistics. See, it's about transportation. We can have a tie-up with one single integrated logistic company. Since we are giving business only to that company, rather than going for different haulage contractors, different transporters, I will have a tie-up with only one person. So definitely that will make sure that a huge amount of material will be transported through this man. So you can always talk to them. You can always bargain. See, currently suppose you are transporting 10 lakh tons of material every year from 5 different suppliers. Instead of that, you catch hold of one person, tell him that, boss, come what may, 8 lakh tons transportation will be done for sure. I can give you minimum commitment of 8 lakh tons. Now give me the best rate. He will also be happy. Okay, now I'm getting confirmed payment for 8 lakh tons from this company. Let's enter into the agreement with this company. Let's safeguard my income. So you can always have the benefit of economies of large scale. So this is how you can bring down the cost. So basically, you should focus on your own logistic abilities, and you should schedule those routes by using operational methods like PERT, CPM, where you can actually find out the route which is the closest one, like what Ola and Uber is supposed to do. The closest route. Now, according to Ola and Uber, closest route is what? Not according to the distance, it is according to the time. If all 3 routes are traffic free, then it will give you the shortest route. But otherwise, it will always show you the, or Google Map will always show you the route which is going to take lesser time. So, accordingly, you can have your own routes so that your operational cost is also minimized. So, that was your second question, which was related to supply chain management. Let's go to the third one. The third one is about, again, ethical and non-financial considerations. Sprinter Sportswear is a multinational company that has a market presence in 23 countries. Yet the company doesn't own a single factory. The production has been entirely outsourced to 175 factories located in places where cost of production is low. Factories cater entirely to Sprinter's procurement demands. These factories operate independently and the company plays no role in their operations. So it's completely 100% outsourcing. Procurement from these supplier network is stored at distribution centers from where dispatches are made to wholesalers of sportswear and apparel. Recent news reports from some of the third world foreign countries have indicated that high child labor employment. Child labor, although against the law in these countries, is resorted in order to keep the cost of operations low. Factories in these countries do not directly employ children. Instead, they subcontract the work to the contractors, and these contractors in turn hire children illegally without the knowledge of local law enforcement authorities. So it is done through contractors. In addition, working conditions in these factories are very unhygienic and oppressive. Sprinter initially turned a blind eye to this problem since it only acts as a customer of these factories. Sprinter as a company has done nothing illegal as part of company operations. However, increased focus given to corporate social responsibility has forced the board members to consider taking action against such factories. Discuss why Sprinter should attempt to address this issue. Why are we supposed to address the issue? I mean, what kind of a question is that? This is, forget about being against the law. This is against the right of these children being of being educated. You're making them work. So it's your moral responsibility to prohibit all such things happening within your organization, because ultimately they will also be a stakeholders. No, any person associated with your business is a stakeholder for you. So if these things are happening, things have to be reported. So my first point here is going to be, we may not be directly responsible. We may not be directly responsible, but we have a moral duty to take care of my stakeholders. We are facing the problem of exploitation of child workers. I know it is not legal. I mean, I know it is not legal, and I still know that there cannot be a legal action against me because I have subcontracted it. Okay, so that is done by contractors, but boss, there is some moral duty, no? If you know that there is something wrong happening, just because it is not your responsibility legally, you can't ignore things because ultimately it's your moral duty to stop all these things. So children have a right to education because every child labor is illegal in almost all countries. So we need to address this issue. Suggest some of the actions. What can be done? You have a strict contract, code of conduct that this should not be allowed. If it is allowed, you can charge penalties. You can have your own audit team, inspection team, which can verify this the way they want, anytime they want. And if things are found out, going against this, if still these practices are going on, any offender will be liable for penalty or even the termination of contract. Basically, strict action needs to be taken. Then you should have a list of its website location-wise suppliers from whom it procures the product. It can give the information about products made by each supplier, average age and worker diversity. This will enable to watch groups to know who is the supplier, and they can warn company if there is any labor issues within these factories. So you can extract the information from the market, you can extract the information from the people by simply listing these names. Okay, I am having these people as suppliers. So if someone knows that okay, in this particular company if there is a child labor going on, or that there is a exploitation of children going on, they can report it to you directly. Are you understanding this? So that was your point number 3, guys. Question number 3 rather. Fourth question. Established in the year 1999, FF Company is the pioneer of fast food in the Southampton. It delivers a truly fresh, affordable, made-to-order sandwiches, burgers and other meals in friendly and relaxed environment. The popularity of the sandwiches, burger, etc. continued to grow over decades, but one thing remained the same, and that was the core values and principles. Principles were like always provide exceptional services to valued guests, provide the highest quality menu items to at a price everyone can afford and enjoy, so you are price sensitive. Keep operating costs low and ensure the great systems in place and never stop improving. It provides comfortable place for people to unwind our interesting conversations from the beginning. As it continues to grow, it is guided by passion for delighting customers by serving fresh, delicious food right in front of the customer. The performance report for the year 21-22 was presented by the managing committee as follows. We expected 2 lakh units to be sold. We managed to sell only 1,65,000. We expected sales to be 10,50,000 pounds, but actually it went down to 8,46,450 pound. Variable cost has also gone down. Fixed cost has gone up though. So there is a huge impact on profit. My profit has gone down. The management accountant of FF believed that the size of fast food market deriving the budget number of burgers will be sold is overestimated. He has computed the value of sales volume contribution planning variance to be 26,062.50 adverse. It is sales volume contribution planning variance. Guys, let me briefly revise the concept for you. You have sales volume variance which is split into two parts. Which can be split into two parts. Planning and operational. Please understand this. To be more precise, I would prefer the initial calculation, if you remember. See, your overall sub-volume variance, final variance. Let's assume that there is no mix there. We are talking about only burgers. So, your volume variance will be the last variance. There won't be any mix variance. So, this will be split into two parts. One is market size and the other one is market share. One is market size, another one is market share. Sales volume variance. Now see, when I talk about multiple products, I will have sales mix and sales sub volume as a part of it. Now, since we are talking only about burgers, there is no multiple products getting dealt in. Okay, we are not dealing with multiple products. One product if we are dealing with, there is no mix variance. So, your volume and sub volume both are same. So, volume is an outcome of market size and market share. Out of that, if you talk about market size, it is non-controllable because I have to face it. It's because of the change in the market. But market share variance is something that is within my limits. So, something which is within my limits is operational variance, and something which is not within my limits as a manager will be considered as planning variance. Are you getting me? They are talking about sales volume planning variance to be 26062. They are talking about sales volume planning variance to be 26062. So, this is your 26062. But one point you need to understand, they have applied contribution. That means they are not dealing with sales variances. They are dealing with profit variances, which are also known as margin variances. And whenever you go for margin variances, you do not apply the budgeted selling price in the calculation, you apply budgeted contribution per unit. Actually, you apply budgeted profit per unit, but since we have been given that it is a contribution variance, that means the company is following marginal costing technique of variance calculation. Company is focusing on marginal costing for getting variance calculation done. And whenever we follow marginal costing technique for variance calculation, it is not the profit, it is a contribution which is taken as a base. Guys, sales volume variance will be dependent on selling price, budgeted selling price, but this is no more a sales variance, it is a margin volume variance. That too on the basis of marginal costing. First of all, margin volume variance will be multiplied by your budgeted profit per unit. But since it is margin contribution variance, it will be multiplied by budgeted contribution per unit. So, we have realized one thing, that this portion is 26062.5, which is adverse, which is calculated on the basis of margin, which is calculated on the basis of budgeted contribution per unit. That is one thing I wanted you people to understand. Next part. Further, the report also included customers' feedback, and the majority of the comments were, I ordered 2 burgers at 2:10 p.m. After half an hour of waiting, I called the waiter and asked him what happened. He told me that he will check in the kitchen. So, he is clueless. I got the order after 45 minutes of waiting, and the cafe is not good in terms of delivery time. So, you have a problem with delivery time, which is costing you customer satisfaction. The budgeted cost data shown in the table is based on the assumption that total market size would be 4 lakh units. Guys, this is based on 4 lakh units. If market size is 4 lakhs, I am planning to sell 2 lakhs. If budgeted market size is expected to be 4 lakhs, if market size is expected to be 4 lakhs, I'm expecting my contribution to be 2 lakhs. I thought I will sell 2 lakhs out of those 4 lakhs. That means I was anticipating my budgeted market share to be 50%. Am I right? Okay. Prepare a reconciliation statement of budgeted profit to actual profit through, oh my God, marginal costing approach. We already know this. I told you, bachas. They asked for contribution, that means it has to be marginal costing. Even if they wouldn't have mentioned this, I would have still followed marginal costing only. So if you are following marginal costing instead of budgeted profit per unit, we are supposed to focus on budgeted contribution per unit. Second, implication of reconciliation statement, and third one is management is worried about customers' feedback, advise measures to improve delivery service time. Okay, guys, they have asked for reconciliation of budgeted profit and actual profit. That means basically they want to find out what are the different reasons for the difference between budgeted profit and actual profit. So basically they want to know reasons for profit variance. They want to know reasons for profit variance, and reasons for profit variance are split into two parts: due to sales, due to cost. Due to sales, when you talk about, it is your margin price variance and margin volume variance. Margin volume variance is split into two parts. It's margin mix and margin sub volume. Margin sub volume is split into two parts: market size, market share. I hope you guys are understanding this. And due to cost is your all variance is related to material, labor, variable overhead, fixed overheads. If you see this question, I can see variation in the sales quantity. That means there is a sales volume variance. If there is a sales volume variance, it will be due to market size and market share. Guys, we are talking about only burger segment. That means we are dealing with only one type of product. If we are dealing with only one type of product, there won't be any mix variance. If there is no mix variance, sub volume and volume variance will be the same, no? So basically in this question, it will be like this. Margin volume variance will have market size, market share. Margin volume and margin price will give you one of the reasons for profit variance, which is your reasons due to sales, amount due to sales variances. As far as cost is concerned, yes, there is some variation in case of variable cost and there is some variation in case of fixed cost. We can get it done later. Let's understand sales volume variance and margin volume variance properly. We have been given sales volume contribution variance. That means it is a margin variance. If it is a margin variance, it should be multiplied, the variation in quantity should be multiplied by budgeted contribution per unit. So guys, basically it is variation in quantity. You can say budgeted quantity minus actual quantity. This will be multiplied by budgeted contribution per unit. This will be multiplied by budgeted contribution per unit. That means we need to first find out the budgeted contribution. Am I right? Okay. So I would like to go for that part first. From the question, I will find out first how much is the budgeted contribution. I have been given sales, I have variable cost. So 10 lakh 50 minus 6 lakh 33. 10 lakh 50 minus 6 lakh 33, 10 lakh 50 minus 6 lakh 33 gives me 4 lakh 17,000 UK pounds. Is this part clearly understood? So naturally, your budgeted contribution per unit is going to be 4 lakh 17,000 divided by your budgeted quantity of 2 lakh units. $2.085. This is what your answer is. Budgeted contribution per unit I have calculated. Budgeted contribution per unit I have calculated. Now, since they are talking about margin variance, since they are talking about margin variance, contribution volume variance, which is a planning variance. Since they are talking about planning variance, they are talking about market size variance. I hope you guys have understood this thoroughly. Okay, I'll give you one more example that will clear your concept here. 1 lakh units I thought of selling. 1 lakh units I thought of selling. Okay. I realized that I can sell 1 lakh 50 due to market changes. And I managed to sell 1 lakh 80. My traditional variance is 80,000 favorable. But guys, since I have already realized during the year that instead of 1 lakh, I will be able to sell 1 lakh 50, this is my planning variance. And my operational variance is 30,000 favorable. So out of 80,000 favorable, 50,000 favorable was any which way anticipated, and it is not because of your efforts as a company, it is mainly because of the opportunity given by the market, and that is your market size variance, which is termed as planning variance. So whenever we go for market size variance, this can also be called as market size variance. Market size variance means you find out the actual change in the market size. Like I will calculate here, market size variance here will be 50,000 units I am selling multiplied by contribution per unit. Now please understand one thing, I don't know how much is the market share of mine, but I can still find out. So I was anticipating 50% of the market size to be sold. Listen, market size was anticipated to be 4 lakhs. If 4 lakhs goes up to 5 lakhs, 4 lakh units were expected to be sold by all the manufacturers in the industry. Now it has gone up by 1 lakh, it has reached to 5 lakhs. That means all manufacturers in the industry will be able to sell 5 lakh units. So 1 lakh extra units will be sold by all the manufacturers. I will not be able to sell all 1 lakh. My share is 50%. So 1 lakh is the total rise in the market size. I will be able to sell 50% of it. So market has given us opportunity to sell 1 lakh units more by all manufacturers put together. My market share being 50%, I will be able to sell 50,000 units more. So when I talk about my calculation, it is going to be 50% of revision in market size. This is quantity. This will be multiplied by budgeted contribution per unit. And I know this is 26,062. This is 26,062.5. You got my point? So my revision is 26,062.5 divided by 50% divided by budgeted contribution per unit. How much is budgeted contribution per unit? 2.085. So revision in market size is 25,000. Since it is adverse, since my revision is adverse, this tells me that actual market size, which was 4 lakhs, that has gone down by 25,000 and now it is 3,75,000 units. You understood this? 2 lakhs has gone down to 165. I'm not concerned with that right now. My question says my volume planning variance, that means the one which was expected, is 26,062.50 adverse. That means I was anticipating fall in the market size. Because whenever I talk about sales volume variance, there are two parts: market size, market share. Market size is beyond my limits, beyond my controllability. So it is uncontrollable, it is planning. Market size going up is a market phenomenon, I don't have a control over it. That has made me realize that if market goes up by 1 lakh units, my share is 50%. So if this was rise of 1 lakh, I would have sold. That gives me an opportunity to sell 50,000 units more, and that's my market size variance. If it is going down by 1 lakh, 50% of it, my sales will be affected to the extent of 50,000 units. So revision in market size was not known. I knew budgeted contribution per unit. I knew the variance. Now I have got to know, since the variance is adverse, 25,000 adverse, my quantity must have gone down by 25,000 units. My means my industry quantity must have gone down by 25,000 units. So market size earlier was 4 lakhs, now it is 3,75,000. Have you guys understood this? If you see the other calculation, 26,062.5 is my variance as per with respect to contribution of 2.085. So guys, that shows that my share adverse, my share has gone down by 12,500. If my quantity is going down by 12,500, that means industry quantity must go down by 25,000 because my share, budgeted share, is 50%. You understood this? So entire market size has gone down by 25,000 and it has reached at 3,75,000 units level. So on the basis of this, I can find out volume market share variance, which is operational variance. Market going up, down, I don't have a control, but my quantity going up, down is completely my reach, my lookout, my controllability. So guys, now I'm going for the next calculation. I have realized one thing, that my actual market size is down by 25,000, 3,75,000 units. My budgeted share is 50%. So ideally, I should have sold in reality 3,75,000 into 50%. 1,87,500 units. Oh my. But I have actually sold 1,65,000 units. I have actually sold 1,65,000 units instead of 1,87,500. If I have sold 165, there is a reduction in market share. 187,500 minus 1,65,000, 22,500 units. So guys, my market share variance, ideally, if the market size is 375, I should have sold 187,500. I have sold further below that. That means market is not responsible for this. It is my responsibility. So 22,500 units multiplied by contribution of 2.085. And even that will be adverse. Even that will be adverse. I hope you guys have understood this part. So guys, you can copy this solution from here. You can pause this video, you copy this first. Now you can copy the next part of this solution. And now I'm going for the next variance to be calculated, and that's margin price variance. Margin price variance is variation of selling price on profit. You already know by whatever margin selling price changes. If your selling price is going up by 10 rupees, your profit as well as sales both will go up by 10 rupees. So your margin price variance is nothing but your sales price variance. We can directly get it calculated. We can directly get it calculated from the given data. My sales 10 lakh 50 and 2 lakhs. 10 lakh 50 budgeted sales, 2 lakhs is my budgeted quantity. Eight 46 450. 846 450 divided by 1,65,000 units. Is this part clear? And your price variation is affecting you only to the extent of actual quantity. So 5.25 was expected to be the selling price. 846 450 5.13 into 65. Guys, your selling price has gone down. That means even in case of price, there is an adverse variance of 19,800. Why are we doing this? Because we are going for reconciliation. If you are going for reconciliation, you need to give reasons for profit. So guys, we were looking out for profit variances. And in case of profit variances, we have just now completed margin price calculation, and in margin volume we have market size as well as market share variance. So due to sales part is done. Let's go for due to cost. And in cost I have variable cost structure, but we cannot directly compare variable cost. It has to be at par. Guys, variable cost variance must be calculated at a common level of actual output. See, I need to know standard variable cost at actual output level. How much is my variable cost, guys? 633. When the quantity was 2 lakh units. I have actually produced 1,65,000. That means my actual variable cost is for 1,65,000. So 633 divided by 2 lakhs into 1,65,000. 5,22,225. So variable cost variance. When I produced 1,65,000 units, I should have actually incurred 5,22,225, but I have actually incurred 537,075. 537,075. Oh my God! Minus 537,075. Okay, that means 14,850 adverse is my variance as far as variable cost is concerned. You understood this? All variable cost structures, whether it is material or labor or variable overheads, variance calculation must be done at par. So your entire budgeted data, entire standard data must be converted from whatever level it is, and it must be brought down to the level of actual output. So guys, 633 was a cost of 2 lakh units. If I'm producing 165, the cost should have been 522,225. But actually I incurred 537,075 to produce same 1,65,000 units. Oh, that means 14,850 I have incurred more. And as far as fixed overhead is concerned, guys, it is fixed overhead cost variance. Let me remind you, whenever we go for marginal costing technique, we don't apply absorption costing technique. That means absorption rate calculation is not required. So in any variance, wherever you need, wherever you use absorption rates, those variances will be vanished. You won't be having fixed overhead volume variance, you won't be having fixed overhead calendar variance, capacity variance, idle time variance, efficiency variance. The only variance you calculate is budget variance, because that is the variance where you don't use absorption rates. So guys, your fixed cost should have been 157,500. Your fixed cost should have been 157,500, but your actual fixed cost is 1,65,000. Your actual fixed cost is 1,65,000. So 157,500 minus 1,65,000, 7,500 adverse is my fixed overhead variance. 7,500 adverse is my fixed overheads variance. Have you realized what I have done? I have evaluated the entire variation in profit due to sales. Sale price, volume. Sale price, direct answer. Because your sales price variance and margin price variance both are same, because increase in selling price, decrease in selling price will have the same impact on sales as well as profit. Margin price variance is done. As far as volume variance, market size variance was given. So we found out market share variance. To what extent market has hit me, 26,062.5. To what extent I have hit myself, that is 46,912.5. I couldn't maintain my market share in the market. I couldn't sell the required quantity in the market. And then cost structures, we don't have information about material cost and labor cost and variable overhead separately. So variable cost variance was done together by taking it to the level of actual output. And fixed overhead, as you know, since we are following marginal costing technique, the only variance that will come up is the variance where I don't need absorption rates, and that is my budget variance. Oh guys, are you clear with it? So now I am going for the main part of this topic, that is reconciliation. Reconciliation of what? Reconciliation of what? Budgeted profit. How much is your budgeted profit? 259,500. Okay, the whole thing is in pounds, so 259,500. First one. Due to sales. In sales, you have margin price variance, which is 19,800 adverse. Then I have margin volume variance to be recorded. And guys, in margin volume variance, I have market size, market share to be recorded. So market size is known to me, so planning. Market share is an outcome of my failed operations. So this will be 26,062.5 adverse, and this is 46,912.5 adverse. 46,912.5 adverse. So 19,800 was due to pricing. 26,062.5 was due to market size going down, and 46,912.5 was because of my pathetic performance in terms of maintaining the quantity. So 92,775 adverse. Okay, so my expected profit was 259,500. It is going down by 92,775 due to sales. Balance must be due to cost. Balance must be due to cost. In that I have variable cost straight away. 14,850 adverse and fixed cost 7,500 adverse. 14,850 plus 7,500, 22. 350 adverse. Have you realized something? See, you anticipated your profit to be 259,500. Due to sales, it is going down by 92,775, and due to cost, it is going down by 22,350. And finally, it has gone down to the level of 144,375. Are you getting the same answer on Cal C, guys? At least I have got 144,375. 144,375, and that's my actual profit. I hope you guys have understood the reconciliation part. Please copy the variable cost and fixed cost part first. And now you can go for reconciliation. You understood this? So, why contribution? Because they asked me. Plus, they also informed me that marginal costing technique is to be used. Since marginal costing technique was supposed to be used, instead of profit per unit, I applied contribution per unit. Instead of fixed overhead, all variances, I focused only on budget variances because that is the only variance where I don't use absorption rate. Budgeted overheads minus actual overheads, I do to get the variation done. So guys, market size is separated, market share is separated. This is not your responsibility. This is thoroughly your responsibility. This is what an outcome of reconciliation is, which is asked in the second part of the question. What is asked in the second part of the question? Implication of reconciliation statement. If you are comfortable with their calculation, go ahead. Otherwise, you can apply the note which I have given you. So what is the implication of reconciliation statement? This is whatever we have discussed so far is the implication of statement, reconciliation statement. My market size has gone down, that has affected me. And apart from that, where I was supposed to sell some 1,87,000 odd units, I could sell only 1,65,000 units. That has brought me further down. My price also played a negative impact on my profit because my actual price has gone down. And then my variable cost has also gone up, my fixed cost has also gone up, which has cost me the huge reduction in my profit. This is what the implication of that reconciliation is. You can always refer to that. It is the same thing that we have discussed. Next part is how to improve the measures. See, your major problem was delivery time. If you recollect, your major problem was delivery time, right? So you need to improve the delivery time. You can go for information technology, you can go for quick order taking. You can have a direct connection. When you take the order on the device, it is directly printed, it is directly displayed in the kitchen, and your preparation starts once the order is placed. So by the time the waiter takes the order, he goes to the kitchen, he places the order, the time is saved. Plus, your material should be made available in a handy manner. It should be made available whenever you need it. Your employees, if they are not working properly, there must be some issues with the job satisfaction. You need to find it out. Maintain the stock. Employee satisfaction, okay, you can give them incentive, better pay, training. Customers should be informed. This is the last point, which is, see, first 3 points, whatever we discussed were quite common, how to reduce the delivery time. But the most important is you should reach the customer and tell them upfront that there will be some delay. You can't keep them hanging. You can't keep them stranded. You have to inform them, sir, it will take some time. You can give them a discount coupon for the next visit. Keep them happy, make them happy, because you want them to come back. So when they feel that, okay, you are remorseful of the delay that has caused because of you, they will take things seriously. They may think of giving you one more chance. Plus, The discount coupon will do the magic. They will definitely come back to you with this additional for availing that discount. Okay. So see, electronic board also they mentioned, install electronic board. So guys, this is what you need to do to safeguard your business. So that was your question number 4, guys. Next question is question number 5. Capson Industries is an electronic company producing office equipment known for the printers which are cost effective and durable. In order to maintain and improve the competitiveness, Capson focuses on strategic cost reduction through continuous improvement. You are the management accountant and practicing independently as a freelance consultant. You are hired as a consultant by the management of Capson and currently evaluating whether to outsource the production of a drum used in its best-selling laser printer or should continue manufacture in-house for the coming year. Outsource vendor quoted a price of 225. So if I decide not to manufacture, I will have to spend 225 on buying the product. The product engineer explained to you that the toner cartridge is the container that holds the toner powder. The drum unit is an electrically charged cylinder that passes the toner powder onto the paper and to create text and images. Based upon the estimates of the marketing department regarding the number of printers to be sold in the upcoming year, the production head estimates the consumption of 40,000 units of D32. So if I'm not producing 40,000 D32, I will have to buy 40,000 332 at 225. Product summary. If I produce direct material 33.975 lakhs, labor 16.47 lakhs, and other overheads, production overheads, lease rental, admin overheads. This is for 36,000 units. Okay. You also gather the information relevant to the product which signify during the upcoming year. Direct material prices and labor rate are expected to increase by 6% and 5% respectively. Leases can be terminated, but the cost of termination will be equivalent to half a month rental. Lease rental are static over the year for the next 3 years. So it's a fixed cost. Space and plant have sufficient idle capacity to absorb the increased production, so there is no opportunity loss as such. 60% and 30% of production overhead and admin overheads are variable in nature. Rent is fixed and unavoidable. Total variable costs are directly and linearly proportioned to the volume of production. Production overhead cost is expected to increase by 3% due to inflation effect. You are crunching the numbers to advise the management. In the meanwhile, come across VP production who indicates that producing D32 will become a cheaper in the upcoming year because production costs will reduce significantly on account of initial proposed instead of an increase in it. Hence, advise you to analyze the decision ignoring the increase in the cost of production, rather advise to consider them at a lower level than the current level. Basically, his pain is something else. He detests to see the scope of his work getting dwindled and don't want the apple of his eye to be laid off. He has a different problem. He does not want his product to be scrapped. Advise the board to outsource or to produce. And you know it nearly impossible to attain the cost reduction as described by VP. But you are also dejected through the possible layoff of largely dependent on your advice. If you advise outsourcing, there will be a layoff. He will lose his job. How would you respond to this dilemma? First, we'll go for make or buy concept. See, 40,000 units, if you are buying, you will end up spending this, correct? Apart from that, lease agreement is, they said no, lease agreement is static. So 15.60 lakhs, 15.60 lakhs is currently getting incurred for 1 year. So 15.60 lakhs is currently getting incurred for 1 year. 6 months payment has to be made. So that comes to 65,000. So 90 lakh 65,000 is a cost of outsource. So even if you wind up the production process, half month's lease agreement has to be paid. They clearly mentioned here. So even if you cancel it, you're not going to save entire 15.60. Some portion has to be incurred, and that is 65,000. Okay. What if we decide to produce? Very simple. This is my current cost of 36,000. So 33.975 I'm spending on 36,000. Now I'm planning to produce 40,000. So it will be 37.75 plus there is an anticipated 6% rise. That will give you this cost. 16,47,000 is a labor cost of 36,000 units. How much for 40,000? But there is a 5% rise. So that gives you the other cost structure. Production overhead, same thing. 23,72,000 is for 36,000. We are producing 40. How much for 40,000? Plus there is anticipated rise. Plus they have also told us something about production overheads. Only 60% of production overhead is variable. So whatever calculation we are doing is applicable only for 60%. Are you getting me? Balance is fixed. Irrelevant it is. Why would I discuss that? It's not going to get affected. Correct? Since you are going for decision making, you all know that fixed cost will not change, fixed cost will not be affected. So it's not a relevant cost for us. So 23.72 lakhs is your total production overhead. 60% is variable. This 60% variable, this 60% variable production overhead is for 36. How much for 40? Cross multiplication and plus the rise. Lease rental will be intact. Admin overheads 6.23, 30% is variable. So this is my total variable admin overhead for 36. How much for 40 plus the change? So I'll end up spending 93 lakhs 25,670 to produce the product in-house. If I outsource it, the work will be done in 90 lakh 65,000. That is going to save my 2 lakh 60,670. So rather than, if it is outsourced rather than producing, there will be a monetary benefit. So we should go for it. But then there are a few concerns about outsourcing the quality of the product. See, if you are outsourcing, someone else is going to produce something for you. If you do it for yourself, you will always be quality conscious. If someone else is doing for you, you may not be equally quality conscious. Secondly, timely supply and whether he will be able to dispatch the entire quantity. Three things have to be seen. Now, other factors like possibility of layoffs, employee morale will go down, and that will disturb your value chain basically. It will disturb your value chain for sure. See, when you analyze value chain, if there is any non-value added activity, you scrap it. If it is a value added activity, then it needs special attention to be given. Okay, so the component may not be a key component, but we have to see from the customer's perspective. As we are outsourcing it, there can be a problem of timely delivery, there can be a problem of entire quantity to be supplied by the supplier, there can be a problem with the quality as well. So this factor is also to be mentioned. One is possible layoff, second one is employees morale due to layoff. It can cause a problem It can cause a low productivity on those who are currently working. They may see it happening with them also. They may anticipate that. And the third one is your control over value chain has to be perfect. Apart from these factors, there is one dilemma. If you follow the principle of integrity, the management should be informed and advised fairly. In that case, the description given by VP will be completely ignored. The recommendation to management shall be based on pure facts and fair estimates which are collected and analyzed with due diligence. If I am saying that there will be a rise in the cost, I should have some valid support. I should have some evidence when I say that. Some due diligence has to be done. Maintaining professional behavior and independence, fair recommendations shall be submitted to the management. Ignoring the personal dejection and verbal indictments of VP production, recommendation of management may include possible impact and the effect of the decision. So even if you feel that there will be a layoff, you have to take a harsh call. You don't have an option because ultimately you're hired by the company. You're supposed to think from the betterment of the company, and company is better only if there is an outsourcing. ZAP has 3 divisions, Z, A and P, which makes products Z, A, P respectively. For division A, the only direct material is the product Z, and for P, the only direct material is product A. So Z will be transferred to A will be transferred to P. Division Z purchases all its raw material from outside, obviously being the first process, being the first division. There is no internal transfer possible, so we are buying it from the outside market. Direct selling overheads representing commission to external sales are avoided if there is an internal transfer, obviously. Division A additionally incurs 10 per unit and 8 per unit. Division A additionally incurs 10 per unit and 8 per unit delivered to external customers. If it is delivered to external customers. A also incurs 6 per unit picked up from Z. So guys, A gets the material from Z, and after getting the product from Z, it spends 6 rupees. There is an external supply at A's factory which has quoted a price of 85. So A has an option. A has an option of buying the material at 85. A has an option of buying the material at 85, or else A has an option of taking the product from Z. But if it takes the product from Z, it has to spend 6 rupees. Guys, that means, can I say the transfer price cannot be more than 79? 85 minus 6. If the product is available in the market at 85, A will never be interested in paying more than 85. If the product is available in the market for 85, A will never be able to pay more than 85. So 85 is the maximum price that can be paid. 6 rupees will be incurred after transfer, post transfer. So 85 minus 6, maximum amount that can be given to division Z is only 79. Because if it is at 80, if Z transfers at 80, 80 plus 6 will go to 86. A will never accept that because the product is available in the market for 85. So the maximum transfer price from Z to A is 79 rupees. Discuss the range of transfer and number of units and the transfer price for internal transfer. Guys, the production demand is 20,000. I mean, the capacity is 20,000, but the external demand is 14,000. So external demand is 14, so 6,000 can still be transferred to A. For A, 26,000 is the requirement. For P, 42,000 is the requirement in the external market. How do we go about it? Simple, as I discussed already. How much is the cost for A? A will not be interested in paying more than 79 for transfer. And if you see, the variable cost of transfer will be 70. The variable cost of transfer will be 70 because if you transfer this need not be incurred. This is external sales agent's commission, no? So, variable cost of transfer is 70. So, can I say range of transfer price will be 70 to 79? A will not accept for more than 79. Z will be reluctant to transfer in less than 70. 70 is what Z has incurred. Z would expect at least 70. A would not accept anything more than 79. So, 70 to 79 is the range for transfer of Z. Correct? P is buying something for, okay, this is external supplier rate 135. So, P would restrict its outflow to 135. P will never be ready to pay for more than, P would never be ready to pay for more than 135. Now, let us understand what is a preferred price for A to transfer its output to P. If A takes the material from Z for 70 rupees, there will be 6 rupees on processing, plus there will be labor cost of 50, plus there will be 8 rupees additional cost which is mentioned in the question. So, 70 plus 8 plus 6 plus 50, 134 is the transfer price, and P would be happy to buy the product from A because the division P is saving 1 rupee. Are you understanding this? So, the transfer range actually, if you compare Z and A, it is 70 and 79. I will go in the reverse direction. 135 is what P is ready to pay, minus labor 50, minus other expenses 8. So, the total cost should be, total cost of material should be 77, which includes 6 rupees processing. So, A cannot pay more than 71. So, that 70 to 79 is also getting shrunk. So, your product can be transferred at 70 or 71, not beyond that. At 70, there will be no profit, no loss for Z. At 71, Z will earn 1 rupee profit. There will not be any profit for A. How? 71, if it is a transfer price from Z to A, 6 rupees will be processing charge, 50 will be labor charge, 8 rupees will be your extra expense on transfer. So, the range is, final ultimate range is between 70 and 71. So, if Z transfers at 70, first of all, you have only 6,000 units to be transferred, but pay attention. A can produce 30,000, 26,000 is external demand. If 26,000 is external demand, only 4,000 units of A are required to be transferred. So, only 4,000 will be transferred from Z to A also. Even from Z to A, there will be 4,000 only, even if your capacity is 6,000. You understood this? So, these 4,000 units can be transferred at 70. If you transfer at 70, the total cost of A will be 134 and there will be a contribution of 1 rupee. But if A transfers at 134, there will be no contribution. A transfers at 135, there will be a contribution of 1. You understood this? Division Z transfers at 70. Cost of A is 134. I showed you the calculation. Cost of A is 134. A has two options, transfer at 134, transfer at 135. If it is at 135, there is a contribution of 1. If there is no transfer at profit, if the transfer is at 134, it is indifferent. For P, if you see, it is available for 134. P would definitely love to buy it from A, and P will be benefited. by 1 rupee because it is available in the market for 135. But if P decides to buy the material from the market, if P decides to buy the product from the market, it is available at 135. If P is getting it at 134, then there is a benefit. What if A transfers at 135? Now division P will be indifferent. You take it from A, you are paying 135. You take it from the external market, it is still 135. Doesn't matter. So guys, basically the range is very clear here. $70 is the transfer price, maximum from company's perspective, and that too for 4,000 units. That's it. I hope you guys understood this. That was your question number 6. K Automobile Group is among the 20 business houses in India. It has been founded in the year 1930. At the height of India's movement of independence from the British, the group has an illustrious history. K's footprint stretches over the wide range of industries spanning automobiles, two-wheeler as well as three-wheeler manufacturer. K's headquarters is located in Hyderabad. Bike production is one of the segments of K Group. Management of K wants to analyze the following actual information for the month of April. Cost data. Customer complaints 35 per hour, equipment testing 18 per hour, warranty repair cost 1560 per bike, manufacturing rework done at the rate of 228 per bike. So bike requiring manufacturing rework 3200. If you multiply, you'll get the cost. Warranty repairs, multiply and get the cost. Production line equipment testing 1600 into 18, and finally customer complaints 2000 into 35 per hour. I can easily find out the cost structure by multiplying these factors. Due to the quality issues in the month, the bike production line experienced unproductive downtime, which cost 7,70,000, so that is additional loss for us. K carried out a quality review of its existing suppliers to enhance quality level during the month of 125. Prepare a statement showing total quality costs and advise 2 measures to reduce the non-conformance cost. Non-conformance means when you fail to deliver the quality, it is non-conformance cost, because a customer is expecting some quality from you. When you don't deliver, it may cost you something, either in the form of reduction in volume or in the form of reduction in customer base or in the form of long-term customer loss. So guys, you are just supposed to classify this. See, you multiply and get the answer. When you do the supplier review, you are preventing it. You are preventing the damage. So prevention cost. Equipment testing is appraisal cost. Why? Because you make sure that your equipments are working properly. Guys, you need to know the cost of quality. What do you mean by cost of quality? Cost of good quality and cost of bad quality, right? I hope you know that part. Good quality means prevention and appraisal, and cost of poor quality is your external failure, internal failure. Internal failure when you realize it, external failure when your customer realizes it. Okay, so that is cost of poor quality. When you try to maintain the quality by spending something, that is cost of good quality, preventive measures. So prevention, suppliers review, appraisal, you are testing equipments, so that is helping you out in maintaining the quality. Internal failure, downtime, it's because of you. Rework is all because of you. External is customer's complaint and warranty. Warranty will be executed by the customer when customer finds out the defect. No. So that is your classification. What else they have asked? Advise 2 measures of non-conformance cost. 2 measures. You can go for total productive maintenance. Now, total productive maintenance is particularly associated with equipments and machines and the assets which are used for production process. Maintenance of these equipments, avoiding breakdowns is the prime objective. So that is one thing. And secondly, the second important aspect can be total quality management, which is a wholesome concept, which includes total productive maintenance as a part of it, because you will focus on continual improvement of the internal practices, like how to eradicate waste, how to increase the efficiency without compromising the quality. This will all bring down the cost of the product, and the defects and every problem will be eliminated. So basically, it appears that K is not a TQM company at present due to high disparity between conformance cost and non-conformance cost. Customer is dissatisfied, guys, and that portion is huge. Customer dissatisfaction cost is huge. That means you are not following quality norms. So please implement that. That is what you are supposed to comment. Simple. You understood this one? Yes, that was your question number 7, guys. Next question is question number 8. FX Company is a manufacturer and supplier of firefighting and safety equipments for industrial use and follows the international quality standards and uses high grade of raw material. It is a fast growing brand that protects millions of people across India every single day. FX has been offered a bid on a prospective export of 20,000 commercial fire extinguishers with following specification from USA buyer, and delivery terms is FOB. 2-gallon cylinder holding 10 pounds of multi-purpose dry chemical of 380 psi. Material cost structure is given. Basically, just see the total is 3,000. Then labor at the rate of 80, leakage testing, variable overheads, export clearance, fixed overheads. Total markup is 10%, price is 4349, exchange rate is 79.9, and you have got price in USD 54.52. The buyer is negotiating the price and ready to pay only 48. Advise whether it is worth accepting. Simply accumulate the cost structure and decide what is to be done. Only relevant costs will be taken into consideration. I don't need this. It will be any which way incurred. And even if it is getting charged, understand this is an absorption rate. You're not actually incurring 200 per fire extinguisher. So guys, simply accumulate your cost structure. See, it was what? 3960 total minus 200. 3760. 3960 was after including some absorption rate which I'm supposed to recover. That's fine. I'm not actually incurring the cost at the rate of 200 per fire extinguisher. No. So ideally, my relevant cost is material, direct labor, leakage testing, variable overheads, and export clearance charges. All are variable in nature. So 3760 is what I'm spending out of my own pocket. 79.9 is the exchange rate given. 79.9 is the exchange rate given. So 3760 divided by 79.9, it will be 47.06 US dollars. The guy is offering me 48, no? Oh my God. The guy is offering me 48. And see, there is no information given as in we have exhausted the capacity. So that means there is a spare capacity. And if there is a spare capacity, there is no opportunity loss. I'm not going to sacrifice anything. This is an additional quantity produced, and for additional quantity, there is only variable cost which gets incurred. So I'm still saving. I'm getting profit of 0.94. He's giving me a 48. For me, the cost is 47.06. My relevant gain is 0.94 on 20,000. So that comes to $18,800. Now $18,800 come to 79.9 if I apply 15 lakhs 2,120. So we can definitely accept the offer. But of course, there are a few more considerations which are to be taken. statutory appliances to check whether these are all non-financial matters. You check the credibility of the customer. Documentation has to be perfect. Licensing has to be perfect. You see who the buyer is, otherwise you'll land up in a big trouble. You don't want any non-compliance to happen when it comes to legislature. Okay, then find out buyer's creditworthiness, whether he is capable of paying you or not. If not, you take 100% advance, you go for letter of credit system, secure your income basically. Then industry analysis. See, find out the competition in the industry, because if others are giving material or others are selling on credit, you can't simply force people to pay cash to you. They will easily get shifted to the one who is giving them credit. So you have to keep one eye on the competitive moves as well. And then certain additional terms like delivery terms, shipment terms, penalty terms, all these things have to be cleared. Plus, since foreign banks are involved, you should always check the exchange rate, because accordingly bank charges will also be hiked. So all these things are also to be taken into consideration beyond your financial activities. You can go through these points. Export documentation and all that. Like if someone orders you from Pakistan and you're dealing with the person, it's not about right, wrong, it's about being safe. You will be questioned, no? Because you'll have a link. So I'm just giving an example. It's not about being right, being wrong. It's about being safe. So these factors are to be considered. Statutory factors, buyer creditworthiness, industry. One eye has to be on competitors, and additional terms like shipment and penalty clauses and other things. So that was your question number 8. Next question is question number 9, which is based on life cycle costing. We'll first read the question and we'll discuss the concept later. Molds and Dyes was established in 1980 and has enormous wealth of experience in the mold manufacturing industry and serves wide range of plastic molds all over the nation. Over the past decade, M&D has developed the reputation of quality products and services for customer-focused approach. It deals in injection molds, blow molds, die sets and mold base, etc. With a state-of-art infrastructure facility, M&D is able to meet the qualitative as well as quantitative demand of its clients. Its vision and mission is to provide high-class manufactured products by using best quality raw material. M&D has developed a new product M, which is about to be launched into the market and anticipates to sell 80,000 of these units at sale price of 300 over the product's life cycle for 4 years. Data pertaining to product M are as follows. Cost of design and development of molds and all 8,25,000, then production cost is 125 per unit, selling cost is 12,500 per year plus 100 per unit, so it's a semi-variable cost. Administration cost is 50,000 per year, warranty expenses 5 replacement parts per 25 units. So for every 25 units, you need 5 parts to be replaced at the rate of 10 per part. If you are talking about 10 per part, guys, if you are talking about 10 per part, 5 parts will cost you 50. So basically for every 25 units, you will be spending 50 rupees. For every 25 parts, you need 5 parts for replacement. 10 rupees per part is the cost. So 5 parts will cost you 5 parts into 10, 50 rupees. So basically for every 25 units you are spending 50 rupees, 2 rupees per unit is a replacement cost, and then finally one visit per 500 units will cost you 500 per visit. So you are spending 500 on one visit, and one visit comes after 500 units. That means your replacement cost is 2 rupees per unit and your visit cost is 1 rupee per unit, in short. Compute product M, product M's life cycle cost, and suggest two ways to maximize M's life cycle return. Ignore time value of money, obviously. How would you go about it? So guys, we are basically producing, and we are planning to produce and sell 80,000. This will go on for 4 years. The life cycle is 4 years, so my cost will also be incurred for 4 years. 8,25,000 will be taken as it is. There won't be any change. Manufacturing cost 80,000 units into 125. Selling cost will be 12,500 per year. So this will be multiplied by 4 to get the total cost of the entire project, the entire life cycle, plus 80,000 into 100 as it is per unit. Admin cost is 50,000 per year, again per year, multiplied by 4 will give me the total cost. Now warranty expenses, if I talk about, you already know it is 2 rupees per unit. So 80,000 will cost you 1,60,000. And number of visits will cost you 1 rupee per unit. So it will cost you 80,000. I think we have discussed this properly. So guys, look at your cost structure. It is 825, 125 into 80,000. As I told you, 12,500 into 4 years, plus the variable portion, admin into 4 as it is annually given. This is 1,60,000, this is 80,000. So with this, you will be able to get the total cost of the product to be, the product life cycle cost is 1,93,15,000. Simple. For doing this, you will be given marks. And the next part asked is, suggest two ways to minimize, to maximize life cycle returns. If you want to maximize life cycle returns, you have to minimize the cost. If you want to maximize life cycle returns, you'll have to minimize the cost. Guys, please understand. If you want to maximize life cycle returns, if you want profit to be more, naturally you'll have to reduce the cost. And if you really want to reduce the cost over a period of the entire lifespan of the product, please make sure that your initial stage of research and development is completely controlled. When you plan for the product, when you design the product, see to it, your all non-value added activities should be eliminated. Go for value engineering. Evaluation of all the aspects which are related, all the points of all the functions which are related to the product design, product manufacturing. Do value chain analysis. Find out whether there is any unproductive or I would say non-value added activity. Reduce it, eliminate it, or at least try to control the cost if it can't be eliminated completely. Because if you reduce the cost at research stage, development stage, automatically once the product is produced and it is launched and it is sold over a period of 4 years, ultimately your cost structure will also be low. So one thing is your R&D cost, and second one is speed up product launch. Launch your product as early as possible, because early entry into the market will give you an upper hand, will give you edge over your competitors, because they are still into making of the product. By the time they will be ready with the product, by the time they will be ready with their launch, your product must be settled in the market, like what Tesla has done in electric cars. People are still struggling to get their electric cars on the roads. Forget about successfully, unsuccessfully. They are struggling to bring their cars on roads. There are certain companies who are still trying their best. But Tesla is pioneer. So the market share of Tesla is always high. Plus, Tesla was the only option people have had. So naturally the skimming pricing technique was used, and the entire profit is accumulated by Tesla to contribute to the huge research and development costs and marketing expenses. Are you understanding this? So early launch, speed up the product launch will always give you the advantage of working without any competition in the market before your competitors enter into the market. Because once your competitor enter into the market, he will launch his product at a high price. You simply bring down your price. You being a pioneer, people will stick to you. People will be stick to you. People will not go anywhere. Because you are the pioneer of the product. If you are launching the product, if I'm getting your product at a lower price, who's a pioneer in the industry, I would always prefer being stick to you. That is the advantage we are supposed to get out of early launch. So that these were the 2 points related to rise in life cycle return. Let's go to the next question. Next question, I'm sure you won't find it difficult. Hotel Nico, Zealand. Zealand is a country as per the question. An affordable leisure hotel resort is an ideal retreat to escape, unwind, and enjoy peace of mind. Set amid expansive tropical greenery in the enclave of Zealand, Hotel Nico is designed for pleasure, where services reign supreme and Italian style architecture for its 25 classic room. Bakis, entire thing is bakwas. Focus only on this 25 classic rooms you have. Hotel Nico Zealand is a beachfront resort that features a good choice of swimming pool, bar, gym, and variety of restaurants. A wide area of water sports activity like surfing, sailing, jet skiing, etc. are available from beach operators at walking distance. The hotel is synonymous with enjoyment and value for money, with a large choice of every attractive all-inclusive packages. Nico charges guests Zealand dollar 2,700 per room per night. So that's the collection. That's you can say selling price. Of course, we don't write selling price because we are talking about services. So it is a room rent that is being charged. Irrespective of single or double occupancy, the charge is same. Variable cost is 900 per occupied room per night. The Nico is available throughout 365 days in a year and has a 75% of the occupancy rate. Now guys, if you're running a service, it doesn't matter what your capacity is. What matters is how much is occupied. Because unless and until it is occupied, who will contribute towards the sales? So occupancy is important and not capacity. Fixed cost is budgeted to be 9 million and are incurred evenly throughout the year. During the second quarter of the year, usually the room occupancy rate remains substantially low at levels expected other quarters for the year. Nico is expecting to sell 900 occupied rooms nights during quarter 2. Management is considering strategy to improve profitability, including closing the Nico for the duration of Q2 and adopting one possible option as follows. There is a scope to extend Nico by creating enough space to run the rustic Czech Italian style restaurant to serve its guests. Annual revenue, cost and sales volume is given to you. Guys, now concentrate here, understand this. Number of occupied rooms, if you analyze these two squares are worth 1,500. So two more 3,000, two more, another 1,500, another 1,500, another 1,500. So we have reached at 7,500 here. But guys, if you see, this is doesn't have two squares, it has only one. So 1,500 is a value of two squares. How much for one square? 750. So guys, that means your this position must be 7,500 and 750, 8250. 7,500 is still this stage where two squares are worth 1,500. So one square is worth 750. So after 7,500, 750 is added. 8250 is the last column. And at 8250 room days, guys, at 8250 room days, the sales is at peak. The sales is at peak. 30 million Zealand dollar. Cost is at 23.75, which includes 12 as variable. That means around 11.75 must be, 12 is fixed. That means 11.75 must be your variable cost. 23.75 is the total cost, 12 is fixed. That means balance 11.75 must be the variable one. What have they asked for? Note Zealand's home currency and analyze the profit improvement plan. Okay. Guys, if you want to think of profit improvement, first of all, you should know how much is your existing profit. Unless you know your existing profit, you won't be able to comment on improvement. No? If your profit as per proposal is more, you can go for it. If your profit as per proposal is less, you will not go for it. So it's a comparative analysis. So I need to know profit of the company currently. What are they planning for? They are talking about closing Nico in the second quarter. If you close Nico in the second quarter, there will be some loss of contribution in the second quarter. Let me first find it out. My first calculation. Close down in quarter 2. If I close down Nico in quarter 2, there will be loss of contribution which I am earning right now. There will be loss of contribution which I am earning right now, and it is nothing but, if you recollect, 2,700 was your selling price, 900 was your variable cost. So 2,700 minus 900, 1,800 was your total contribution per unit, multiplied by 900 room days, multiplied by 900 room days or room nights, you can say. So 16,20,000 I'm earning right now. This will be lost if I go for close down option. Correct? Of course, there will be new avenues open. There will be new avenues open if I close down. So how much is my other option? How much is my existing profit? I am going for second calculation, statement of my existing profit. So guys, for that we need to first find out total room nights, because unless we know total room nights, we'll not be able to find out the collection and the cost. So let me tell you, there are 25 rooms, but the occupancy is 75% per day. This will go on for 365 days. So 25 rooms into 75% into 365. 6,844 is going to be your total room nights. So your current profit will be contribution minus fixed cost. So you already know the contribution part, guys. 2700 minus 900. You already know 1800 is your contribution per unit. So 1800 into 6844 will give you contribution minus your fixed cost is already available, Zealand dollar 90 lakhs. 6844 at the rate of 1800 will give you total contribution minus 90 lakhs. So Zealand dollar 3.3192 million is your profit right now. Are you understanding this? This is your profit right now. Guys, you are currently earning 3.3192 Zealand dollars. I want to know the plan of the proposal. Now, what is the proposal given? You want to run the restaurant, right? Okay, so profit of the proposal. Profit of the proposal. How much is the profit of the proposal currently? See, my total revenue is 30 lakhs. My fixed cost is 12, my variable cost is 11.75. My room nights given are already 8250. So we can easily complete the task now. Listen to me carefully. So guys, I'm starting with sales, which is 30 lakhs. Sales is 30 lakhs. 30 or other 30 million Zealand dollar minus variable cost. How did you get variable cost, guys? Total cost 23.75 minus 12. 23.75 total cost minus 12. That comes to 11.75. So with this, we'll be able to get the contribution. $30 minus 11.75. So this will be 18.25 million Zealand dollars will be your contribution. This contribution is given for the last column. Total room nights 8250. I hope you understood how did we get 8250. I explained it to you. So contribution per room per night is 2212.12. Why am I doing this? Because guys, as per the company's budget, as per the company's plan, if this is margin of safety, That means this is break even point and this is your actual sales. Actual sales is only 7310. Actual sales is only 7310. So multiplied by actual room nights 7310. 16 point. So your budgeted contribution for actual level is going to be 16.2212.12. Let's round it off up to 2 decimals and then we'll apply 7310. So 16.1705, 16.1705972 millions. Correct? Minus fixed cost. We already know the fixed cost is going to get increased to 12. So that gives me 4.1705972 million profit in terms of Zealand dollar. Are you getting this? How much is your current profit? How much is your current profit? It is this. See, if I don't shut down, first of all, if I shut down, I'll be losing 16 lakh 20. If I continue, I'll be getting 33 lakh around, correct? 3.3 millions. But if I go for the proposal, I'll be getting this. So additional profit will be 1705,972 minus 3.3192. 3192. So 4.1705972 minus 3.3192. 0.8513,972 millions. That is Zealand dollar 8,51,397.2. This is the additional profit that I'll be getting, guys. 8,51,397 is the additional profit that I'll be getting. So guys, we will not close down. I calculated this because this is my loss if I close down. So I will not close down this. I will go for the processing or for the usage in Q2. This will give me a revenue of say 3.3192, 3.3192. But if I accept the proposal, that will give me something else, something more. So my profit would go up by 8,51,397.2 Zealand dollars. So I will accept the proposal. So the calculation says we should go for Italian restaurant. So you can write it later. If you want, you can copy this. We calculated this. This was not asked, but then we calculated it to find out how much we are losing. And we are losing. We are losing. Okay. So my existing profit is 3.31, no? So I would prefer going for new restaurant. You understood this? Okay. Copy this part. 1 and 2. Now you can copy the last part. So either if you want, you're comfortable with the institute solution, you can go for it. Otherwise, you will be you stick to my solution. It is also simple. So I think this is absolutely clear. Let's go to the next question. Question number 11. B Steels is a leading manufacturer of flat and long products and have state-of-the-art plants. These plants manufacture value-added products covering entire steel value chain, right from the coal mining to manufacturing pig irons, billets or other billets, HR coins, black pipe, GL pipe, cable tips, etc., conforming to international standards. The rock-solid foundation combined with non-stop upgradation and innovation has enabled the B Steels to surpass its goal constantly. Its vision and values for sustainable growth is balancing economic prosperity and social equality while caring for the planet. It is preparing its balance scorecard for the year 21-22, and it has identified the following specific objectives for the 4 perspectives. Improve post-sales service, improve employees' morale, improve employees' job satisfaction, increase gross margin, increase number of customers, increase profitability of core product line, increase plant safety, increase customer retention. B Steels has collected key performance indicators to measure progress towards achieving it specific objectives. Key performance indicators are those indicators which will which will give you results of your critical success path. Critical success path is a vision that you have, the goal, ultimate objective which you want to achieve, and the key performance indicator will keep on telling you that whether you're on a right track or a wrong track. Like for example, average replacement time. My goal was product should be replaced in 2 days. It is getting replaced in 1.5. Profit percentage should have been 15, that was my target, but it is actually 16. Similarly, number of customers have also increased. Plant accident unfortunately increased. Repeat customers have gone down. That means there is some issue with the customer satisfaction. Core product line profit has gone down. Employee turnover rate has gone up. Employees are also not happy. Employee satisfaction rating, I was expecting 1 being the most satisfied, but we have got 1.2, little less. For preparation of balance scorecard, the following format has been developed. Okay, so whatever items they have given you earlier, these items, the first table is to be clubbed with the second table, and it is to be recorded here. Financial, customer, internal business perspective, and learning and growth. I hope you recollect. Balance scorecard has got 4 parts. Financial perspective, which talks about shareholders, which talks about profit, which talks about ROI, which talks about only financial matters, profit or loss. Then you have a customer. It is about customer satisfaction. It is about delivering to the customer whatever customer demands, whatever customer needs, whatever customer expects from you. If you fail to do so, you will be losing your customer, there will be no repeat customer, you may lose your customer permanently. Timely delivery, quality delivery, quality of the product, everything has to be taken care of. Internal business process is the operational part of your business, how successful it can be done. All non-value added items are to be eliminated and only value added items are to be considered and focused upon, so that you can actually reduce your redundant cost, unnecessary cost structure. Learning and growth is how you are developing your people, how you are developing your employees, how you are developing your system, how the knowledge is being upgraded, how the training system has been working in this organization. Everything has to be classified here. Prepare a balanced scorecard report using the above mentioned format. Place the objective under the appropriate perspective heading in the report. Select a KPI from the list of KPIs that would be appropriate to measure progress towards each objective. B Steel's desires to integrate sustainability and corporate social responsibility related to KPIs in their balanced scorecard to other visions and values. Advise B Steel's using triple bottom line framework. So, say suddenly they have started with balanced scorecard and now they have inserted triple bottom line. So, guys, how would you go for the classification? Financial, customer, internal, and learning and growth. Okay. So, guys, we can clearly say this increase in gross margin can be financial. Increase in gross margin can be financial. Let us discuss it out here. Increase in gross margin, increase in gross profit, they are talking about, profit here also they are talking about. So, these are all financial matters. Now, what is connected to financial matter? These are your objectives. How would you analyze gross margin growth percentage and then even this profitability? You understood what I am trying to tell you? These four things will be classified under financial perspective. Then I have customer. Then I have customer to be analyzed. Customer. Number of customers. This is customer. This is customer. So, customer is done. So, definitely this will be related to customer only, and plus number of repeat customers will also be customer perspective. Number of customers will be customer perspective, repeat customer will be customer perspective. My third item is internal process, which is this. My third item is this: improve post sales service, increase plant safety. These are internal perspective, where my internal operations will be advanced, will be developed, will be enhanced, will be improved. So, this will be indicated by reduction in plant accident, or you can say average replacement time. Since my replacement time has gone down, that means I am working faster. That is an internal process which is being enhanced, updated. And my last is learning and growth. Employee morale, employee job satisfaction, which will be here. Employee satisfaction and employee morale and employee turnover ratio, employee job satisfaction. Employees morale will decide actually job turnover, employee turnover rate, and employee satisfaction is the satisfaction rating that you can directly connect. You understood this? So, that is how I am supposed to go for the classification, guys. See, this is what we discussed, no? This is what we discussed. Financial means do not look at anything else other than monetary benefits or monetary losses. Customer means only customer, don't think about anything else. Internal business perspective means you talk about the operations that you are handling, you talk about the systems that you have in place in the organization which you need to improve upon. And the last but not the least is learning and perspective, which will enhance your employee base, which will mature your employee base, which will increase their knowledge, inflate their knowledge in terms of the production efficiency, in terms of handling machines, in terms of handling material, in any aspect basically that will improve the efficiency and that will reduce all kinds of wastages. So, see, morale, if the employee morale is high, labor turnover rate will be less. If your job satisfaction is high, satisfaction index will also be better. Improve post-sales service replacement time. Post-sales service, we marked it here, no? Post-sales replacement time. Lesser is the replacement time, happier is the customer. And improve plant safety. If you increase plant safety, automatically accidents will be reduced. So, this is what they have mentioned here. Got it? Now, triple bottom line concept focuses on three things: people, profit, and planet. People, profit, and planet. How? Profit will talk about economic aspects, people will talk about social aspect, and planet will talk about environmental aspect. Now, if you want to implement triple bottom line here, you need to focus on these points: material consumption, energy consumption, water emission, and fuel consumption. These will decide the consumption pattern. You can also think of going for land utilization and recyclability, because all these things will deplete resources, all these things will increase the emission in the environment. So, I am talking about triple bottom line. This is what I mean by planet, environment. If I am talking about people, if I am talking about social, like people working at my organization, people working within my organization, suppliers attached to me, porters related to me. See, when I do a business, there are so many people who are dependent on my business. Okay, I might be having 50 employees, but even supplier is dependent on me, even my customer is dependent on me, even the transporter who transports my good, he is also dependent on me. So, if my business is shut down, I am not the only one who will be affected, all these people will also be affected. Now, that is your social environment, which consists of workplace, which consists of health issues of their workers, human rights, training, education, and all these things. All these different types of people are also associated with your people part. I mean the social part. Economic part, so we already know you are doing well. So, that is why they have clearly focused on the other two, environment and corporate social responsibility. You understood this? So, if you are applying TBL, triple bottom line, economic aspects are already taken care of. I am focusing on social and environmental, profit, people, planet. So, we are talking about planet and people. So, we discussed it out. Take care of the environment, take care of people associated with it, associated with you, stakeholders, basically investors, actual manufacturer, workers, helpers, admin staff, distributors, retailers, wholesale managers or warehouse managers, storekeeper, customer, everyone should be taken care of. That was your question number 11. Question number 12, again a combination of pricing decision and a learning curve. The gift companies makes mementos for offering chief guests and other dignitaries at functions. A customer wants 4 identical pieces, handcrafted gifts for 4 dignitaries invited to this function. For this product, gift company estimates the following cost for the first unit of the product. 1 unit will take 2000 as variable cost. Labor will take 20 hours for first unit. 50 rupees per hour is the rate. 90% learning curve ratio is applicable and 1 laborer works for 1 customer orders. Calculate the price per piece to be quoted to this customer if the targeted contribution is 1500. Guys, learning is applied. That means 1 unit takes 20. Second one will definitely not take 20. Second one will take less than 20 and it will be, I hope you know the concept of learning curve, guys. Learning curve concept says whenever you double the quantity, your average time reduces. Yes, guys. Okay, now how do we manage this? 1 unit requires 20. Is it? Learning is 90%. If learning is 90%, your second unit will on an average take 18 hours, 16.2 hours. 16.2 hours. Are you getting me? 1 unit takes 20 hours. So at that point of time, your total hours are going to be 20. But 2 units will not cost you 40 hours. 2 units would cost you 36. Why? Because average time is 18. 4 units will not cost you 20 into 4, 80. 4 units will cost you 64.8. 64.8 because your average time is 16.2. So guys, statement of price. Material cost, or rather, what is the first one? What is the name of the first one? I'll start with labor only, chal. Oi, labor will cost me 64.8 hours into 50 per hour. 64.8 per hour into 50, so that comes to 3240 plus other variable cost which is given to be 2000. We are going for 4 units, so total will be 8000. 11 to 40, 11 to 40, what is it? Total. This is your total cost. What is the constraint given in the question? They want some contribution. How much do they want? 1500 per unit as the contribution they need. Okay, so this is a cost of 4 units. It is cost of 4 units. 11 240 divided by 4. So variable cost per unit. The relevant cost per unit is 2810. Question says required contribution per unit will be or should be 1500. So I want my total cost, I want to charge 4310 price per unit. You can copy this if you want. I have shown you the calculation of average time and total hours required. Copy this. Is that part clear? If one worker is producing 1 unit, 2nd unit, 3rd unit, 4th unit, every time he will experience some learning, every time he will save some time, every time he is saving some time. Am I right? Learning curve concept says whenever your quantity is doubled, learning is applied on average time. So I was producing 1 unit in 20 hours. So if I produce 2, my average time will not be 20, it is 90% of 20, which is 18. If I produce 4 units, double, my average time will not be 18, it will be 90% of 18, 16.2. Now 16.2 hours per unit, 4 units will take 64.8 hours multiplied by 50 rupees per hour, that gives you labor cost. Other variable cost is also added to that. 240 was my total cost of 4 units. So relevant cost per unit, I am going to spend 2810 on that one product. I want 1500 contribution, so 4310 should be the pricing. And point number 2, 4 different laborers made the product simultaneously to ensure faster delivery. Can the price at 1 be quoted? Of course not. If 4 different people are producing one unit and 4 units will be produced and delivered, you can't see the learning, because every time they will produce 1 unit, they will take 20 hours. Learning will happen only if there is a repetition, and there is no scope for repetition. You want to sell 4 products, you want to produce 4 products, you have told 4 workers of yours to produce one each. So everyone will take 20 hours to produce their first product. And by the time they produce their first product, you have all 4 products which will be sold. So learning effect will not be experienced. In my first calculation, 1 worker is producing 4. So 1 worker is observing learning, which is not possible in the second case. So no, you cannot go for learning in the second part. See, is this part clear? See, they have directly calculated things. I simply showed the calculation. I hope you understood this answer. So that was RTP for you guys. I'm sure it was of great help. Majorly, all these exception, hardly, you can exclude a few, 1 or 2 questions, but major part was already covered in JKSC textbook, if you see. So don't worry about it. We have done enough. If you see the textbook of J.K. Shah classes, you will find these questions. Exception, 1 or 2 questions, but major questions have been solved. Of course, the questions which are not covered in JKSC are so simple, like this question. This was not covered in JKSC, but it is so simple to crack. It won't be a difficult one. Theory, if I talk about, see, I'll give you a briefing. Nutty Bites, the case study digest which I have shot 1 and 2 years back, you have this question there. Supply chain was new, but we managed it. The footwear question was again from the material. Fast food center, this was from the material, JKSC material. This was a new one, but it was quite simple if you see. This was divisional pricing questions from the study material JKSC. This was from the study material of JKSC. I myself have added this question to the textbook. This is also there in the JKSC material. This is also covered in JKC material. This is also in JKC material. We have done this in the class. This was a new part, of course, but it was so simple, the classification part and the last one, as I told you. So guys, just have complete faith in whatever we have done. Just don't think on negative terms. Just don't go by what people are saying. People's topics are difficult, subject is difficult, you can't clear. Whatever we have done is enough. JKC has done enough. Just go for it and trust JKC, because the entire coverage is taken care of. Okay, so have a nice time, guys. All the best. I'm sure you're going to do well, and we are always there with you. You can contact us for your doubts, whether you are a JKC student, non-JKC students. We don't mind solving your doubts. Also, even if you're a non-JKC student, we are there for students. JKC, non-JKC doesn't matter. For JKC students, of course, we are there. But even for other students, we are there. You can contact us. We are always with you. Thank you so much, guys. See you soon.